Hey, good morning, options traders. What's happening, everybody? Well, there's a lot of talk about hedging, and that's because options were designed as the perfect hedging tool. And with the risky markets that we're in, yeah, a lot of people want to learn options on how to hedge, but there is a very big risk of hedging. And so, without going into all of the ways to fix it, let me at least point out what the risks are. So whenever we talk about hedges, is that hedges are put into place to reduce or somewhat offset a loss. And that's an important point right there. Hedges are not done to completely get all of your losses back and then some. They're not necessarily intended to be money makers, but instead just to reduce a loss. Think of it more like insurance. So a classic hedge in the stock market is to buy a put. So let's say that the stock is trading for 100 and you buy a $95 put trading for 5. So your break-even point is 105. That's just the $100 you paid for the stock plus the $5 for the put or for the insurance policy. So now instead of breaking even at 100, you need that stock to rise to 105 just to break even. So here is the original stock position purchased for 100, and that's why the red line crosses right here at 0, right there at the horizontal line. That's our break-even point. If we buy a put, remember a put has negative deltas. And so it's these negative deltas that offset these positive deltas down here. So the combined positions of long stock plus a long put look like this. So by buying the put, we have transformed the position from the red to the blue. And now we've got all of this downside right here mostly eliminated. Not all of it, because we can still take a $5 loss. That's the amount we paid for the insurance. But anything below 95 is no longer a loss, as if we had just held the shares of stock. But now here's where some of the risks come in. We paid $5 for it, but now let's say that put is trading for 8. So it's actually moved in our favor a little bit. That doesn't necessarily mean it's a good thing, because overall we've lost money. But at least the hedge looks like it's paying off. But here's the problem, is you're saying, okay, what should I do now? Well, if you do nothing, then this hedge might go up in smoke and expire worthless. And then you're going to say, well, gee, I paid $5 for nothing because it was worth 8 at one time and I didn't collect it. So this is the big dilemma, the first big dilemma with hedging. And then traders say, well, let me close this now and at least collect some money. All right, fine. So you paid 5, you sold for 8. That's a net of $3 in your pocket. So your cost basis is now 97. So your break even is reduced from the original $100 that you paid for the stock down here to 97. So first of all, it's a little bit of a risk to go out and buy that put, hoping or thinking that the stock is going to fall and then finding out that it actually does. You could have just spent that $5 for nothing. And yet with all of that, you've only reduced the break-even point by 3%, at least in this example. So it wasn't really all that beneficial. But the big problem comes in, how do you monetize this hedge? Should you take those profits, or should you just let them sit there? Because here's the problem, what we call monetizing the hedge, that if you do nothing, you just watch that put go up and up and up in value, well, it might end up expiring worthless. And so there was really no benefit. You ended up with some paper gains along the way, but an actual loss. So in this example, yeah, you might have paid $5 for it. At one time it was worth 8. That's a paper gain. It might be worth 10, 12, 15. Those are all paper gains. But if it expires worthless, it's just a $5 loss. So that's why I say there were no benefits. So again, this is why traders start to say, I don't want to see this happen. Let me try and figure out a good point to close it. So traders learn to sell for very small gains. This is another problem of trying to monetize the hedge or to manage this hedge over time. But then what happens? If the stock falls further, they go, oops, shouldn't have closed my put. Let me go back and rebuy it. So if the stock falls, they now re-enter the hedge at higher implied volatility. So they keep paying more and more for these puts, maybe making some money, maybe not. But let's say right now we're on our cost basis of 97, and now you pay $10 for this put. At some point, if it keeps falling, you're going to buy into this really high implied volatility, and then the market is going to snap back around implied volatility is going to drop and you're going to end up closing for almost nothing. So even though these hedges might appear to work along the way, if you're not managing these hedges in the right way, what will probably happen is this. We started out with a cost basis of 100. We ended up down here at 97, maybe even down at 95 or 92. But as we keep in these positions and keep hedging, probably going to end up somewhere up here, maybe at 103. You end up being worse off than if you had done nothing. Lots of work, lots of commissions, and ended up worse off. This is the big risk of hedging. So it's always about managing the hedge. So probably the main point of this video is be careful about buying puts as a hedge. Placing the hedge is only a small part of the strategy. That's not real hard to say, well, I think the stock might be heading down, or we're coming into earnings season, let me go buy a put. And new traders think that the rest just takes care of it by itself, and it just doesn't. So instead, you must be careful in how, when, and why you're hedging. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.